debt is hiding that recession risk. The accumulation of debt in the third quarter of the 2023 figures in the United States shows us that in the last 4 quarters in the United States, GDP has risen by about $414 billion, with an increase in public debt alone of $1.3 trillion. That means that the United States is not growing, it is getting more indebted. And in this graph, courtesy of Bloomberg Economics, what we can see is that the third quarter GDP was bloated by credit card debt in consumption, as it was driven fundamentally by entertainment, and also increased by revaluation of inventories. Those two things will likely revert in the fourth quarter. But you're also seeing the recession in real wage growth, which remains negative, in the elements that show that the industrial sector is investing less, in the industrial sector as well in terms of new orders, in the manufacturing and services sector, in the ISM indicators. Leading indicators and lagging indicators are showing that the United States is in a private sector recession, disguised by an inflation figure that keeps a certain number of elements still elevated. However, the level of growth is very poor relative to the growth in debt. Let's look at the next graph, which shows us that it's impossible for consumption to remain in the same way that we have seen in the last quarter. Why? Because real disposable income is falling. The slump in real disposable income is likely to hit consumption, because right now most of the increase in consumption comes from rising credit card debt, and delinquencies of credit cards are at a new record high, as well as the level of debt in credit cards. That is a time bomb. Massive public debt plus massive credit card debt. Undoubtedly, those two things hide the recession, but the other elements of the manufacturing, the services, and the capital expenditure parts of the economy are clearly very, very poor. Let's look at the next graph that we're going to see in this environment, which shows precisely that the global manufacturing PMIs, the indices, show how the manufacturing sector remains in deep contraction. The Eurozone is a train wreck. The Eurozone is not just showing manufacturing weakness, but also services weakness. It is in recession despite the largest stimulus package in its recent history, the so-called Next Generation EU Fund. Well, despite the Next Generation EU Fund and an ECB balance sheet that is almost twice the size relative to GDP of that of the Fed, the ECB balance sheet is at 50% of GDP, when the Fed's is at around 30. That is showing the very, very negative environment for the euro area. So if you're worried about the United States, think about the euro area, because at the same time the euro is collapsing relative to the US dollar, and obviously the fiscal imbalances are larger, i.e. it requires a tremendous amount of debt, but it doesn't grow. Very careful with that. China is improving, but it's improving slowly, and it doesn't offset the situation in the real estate sector. Let's go to the next graph, which shows why commodities are weaker than what many expected in a very tight supply market with very high levels of geopolitical risk. what we can see here with oil prices and what we have seen as well with, for example, freights, but also with not just energy commodities, but also industrial commodities in general, is that the monetary policy, the tightening of monetary policy and the decisions of the Fed to remain hawkish, with even the likelihood of another rate hike, apparently, according to the FOMC minutes, what shows is that monetary tightening has a much larger effect than the supply-demand balance and the geopolitical risk. Yes, geopolitical risk is keeping a bottom on oil prices, but certainly demand weakness coming from the slowdown of the economy, plus the monetary tightening from the Federal Reserve, have a much larger impact on the marginal price. Let's go to the next graph and see the absolute train wreck of the monetary imbalances built in some of the economies. Printing money for the people is making people very poor. And what we can see in this graph is the last 10 years, the absolute disaster of those economies that continue to increase money supply well above the production and economic growth, and that continue to bloat government spending with massive increases in money printing. 1 second, in that graph, you don't see the Venezuelan bolivar and the Cuban peso for a very simple reason. They would not fit in the screen. The absolute disaster of the implementation of so-called inclusive monetary policy, which basically means bloating government spending and financing it with printing a currency that nobody demands, shows what an absolute nightmare it is when you hear somebody out there telling you the mirage of the quantitative easing for the people. Thank you very much for following, and keep defending freedom. Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.